Shantanu, good afternoon. Thank you so much for your time. Now, in the last few weeks and months, we've seen several government agencies, several global agencies too, come out and call it out aloud that India will have much more superior growth in among all the emerging market pack as well as large economies. What is your thought? In fact, even RBI has upped the GDP growth estimate to almost 7%. What are your thoughts on growth in the first, and then we go talk about other factors, but in the next 12 months, Goldman's estimate on growth?
Sure. Thank you for having me on the show. On growth for 2023, we think you will close at around 6.7%. We are slower in terms of growth in next year, 2024 calendar year at 6.2, and the reason is because we think that there'll be a fiscal drag as the government tries to consolidate the fiscal deficit from the current target of 5.9% of GDP towards where they want to go in 2 years' time by FY26, which is 4.5% of GDP. Most of the investment growth that you've seen in the economy has been led by the government spending almost 3% plus of GDP on capital expenditure. I mean, just in terms of context, this number was about 1.5% of GDP on average before the pandemic. That's a very sharp increase in government investment. Given the fiscal consolidation path, we think that will slow down. Now, in terms of the private economy taking up some of that slack, we think that the supply side conditions look good, and therefore some of the private investment can come in probably in the second half of the year, but we are not seeing much of that happening in the first half of the year. That's why we are lower than the RBI's estimate on growth next year.
The other thing, what we are witnessing is that the dollar index, after topping out close to 107, has been edging lower, including global bond yields. The hypothesis which is being made is that this could lead to big flows into emerging markets, including India, of course, being one of the shining among all the other emerging markets. Do you see this case of strong inflows into India also at a time when a lot of money is being pulled out of China, which is the immediate competition on attracting flows? Do you think this will play out this year into 2024?
That's right. So we think that there's been a big change in the risk sentiment in global markets around mid of December 2023 with the Fed pivot. We were forecasting, for instance, one rate cut from the Fed earlier in Q4 of calendar 24. We now have a forecast of 5 rate cuts from the Fed, 3 in the first half of the year, and then 1 each in Q3 and Q4 of calendar year 24 next year. This is positive for risk sentiment. We also have a view of a slightly weaker dollar, and all of that should be positive overall for EM assets. In terms of India, not just the flow side, but the current account side is also looking great. We have recently revised our forecast for the current account deficit to 1.3% of GDP for calendar 24 versus 1.9% of GDP earlier. And from the flow side, we are looking at equity flows as well as strong inflows from the bond inclusion that India is getting into by the mid of calendar 2024.
Shantu, how would the rate scenario pan out in India? Do you think India would also see rate cuts starting mid of this year or with a lag compared to US?
So India ultimately did not hike as much. So the hikes that you saw in developed markets or the US in particular was much sharper over the last year and a half, 2 years. And therefore, the amount of cuts that you see from US is not in our forecasts, let's say, for India. We are looking at 2 rate cuts from India, from repo rate of 6.5% to 6% by the end of calendar 24. So we are seeing 25 basis points each in Q3 and Q4 of calendar 24. But remember, the monetary policy in India will be more nuanced than just rate cuts. So one, we see an easing of liquidity in the banking system from the RBI. It's still very tight, and therefore overnight rates are closer to the top end of the liquidity corridor or the MSF. So we first see the RBI easing liquidity, which will let overnight rates fall to the repo, thereafter a change of stance, and thereafter rate easing. So in total, the RBI, even with 50 basis points of interest rate easing in terms of repo can deliver effectively 75 basis points of rate easing just by easing liquidity to the tune of 25 basis points further.
Right. Also, I want to understand from you China and US slowdown impact on India. Do you think the commodities globally, we are a very large consumer of commodities, including crude oil, and deflationary environment in commodities actually will be benefiting our macros. The way US and China growth are actually panning out. What are your thoughts on this?
So on US growth, actually, we are, as a house, we are markedly above consensus. We have US growth forecast for 2024 calendar year north of 2%. Consensus is north of 1%. So we are about 1 percentage point above consensus on US growth. On Chinese growth, we are slightly above consensus, but I think the bigger story is that China trend growth, we see decelerating over the course of this decade. On commodities, while we have brought down our oil price forecast from about north of $90 on average to about $80 on average for 24, and that should be positive for the current account. It's already reflecting in our forecast for the current account deficit at 1.3% of GDP. On metals, given the green energy, green metals demand, we still think it could be bullish for some part of the industrial metals complex. But overall, for India, unequivocally, it is positive in terms of the current account deficit being less than 1.5% of GDP, with oil prices, in our view, averaging about $80 a barrel. Remember one more thing on the current account, apart from just lower oil prices, services exports are now doing about 9.5 to 10% of GDP on average. This was about 7% of GDP in the pre-pandemic period, and that should provide further cushion to the current account balances for India.
Right. How are you analyzing the quality of growth, the ingredients? Because we've been talking about, or everybody's been talking about, a two growth India, right? One is, the K-shaped recovery. The categories which are falling in the affluent India part is growing very well, but mid to lower discretionary, including FMCG volumes, are kind of indicating already that rural and semi-rural tier 2, tier 3 is witnessing slowdown. Do you see improvement in the lower end of the K this year?
Yeah, that's exactly right. So we think that the government fiscal spending has switched already or pivoted already towards some welfare spending. I mean, a case in point is rural employment program, or the expenditure on Narega, which was budgeted for 60,000 crore, 600 billion INR, has already exceeded the budget estimates. It's ranging nearer to 800 billion INR. Plus, we think that it'll go further higher over the next 3 months of the fiscal year. We are going to see the shift from the government playing out, and therefore that, along with the harvest of the winter crop, the rabi, is going to be important for the rural recovery to pan out. Until then, we are seeing a little bit of this two-paced recovery. So the private side consumption is growing right now below trend, whereas investments is doing very, very well, especially driven by government Capex. As I said earlier, we expect some of the government Capex to slow down in terms of growth rate next year. But second half of the year, we remain optimistic that the private sector can pick up some of the slack.
Right. Okay, before I let you go, Shantanu, just a quick word on corporate earnings. Any thoughts on how the earnings of corporate India are actually going right now in terms of growth? I understand you spoke about it. How do you see that reflecting or translating into earnings of corporate India? Because Capex should actually, from private sector, has been lagging government. Up till now, it has been front-loaded by the government side. Do you think that cushion will also be there this year?
Well, earlier in the year, you saw some upgrades playing through on the earnings side. Our equity strategists have been calling out for a positive view on India. They are remaining overweight India in the regional context, and have recently raised the price targets for the index, along with other indices around the region and the rest of the world. Given our positive view on US growth, which we are looking at 2% plus, as I said, about 1 percentage point above consensus, and a slightly weaker dollar cycle, given that we are projecting 5 interest rate cuts next year from the Fed.
Shantanu, thank you very much for your time this afternoon. It was great chatting on thoughts on macros and issues of importance to the Indian economy. We'll take a short break on that note, come back with more news and analysis. Don't go anywhere.